back. Let me now bring on board Navneet Manot, Chief Investment Officer with SBI Mutual Funds, who joins us live from his Mumbai office. Navneet, of course, needs no introduction whatsoever. He's one of the best, he manages some of the best funds which are in the Indian mutual fund industry. Navneet, good morning. Good to have you back on ET Now. Thank you for joining us. Navneet, last 15-20 days have been rather volatile and horrible for Indian markets. Do you think worst of the fall is behind us?
Yeah, it's not only for Indian markets, but financial markets in general. So several other markets have seen similar upheavals. I think all emerging market bonds, currencies, emerging market equities, even the US Treasury market, on the talk about the tapering since May. But I think that trade is getting a little overplayed, that the Fed is going to taper off. But I mean, that was an event that had to happen one day. And good that the market has started pricing in a lot before the actual event that takes place. So my sense is that, you know, every few months the global markets need one story to anchor. So till it's quite surprising that till few months back the concern was the US fiscal cliff till January or February, that US economy may slow down if the fiscal cliff happens. And suddenly the focus has shifted to a strong recovery of US, which is leading to tapering of the quantitative easing. But maybe a few months down the line we may have something different, like last year we had probably the imminent collapse of euro, which was the fear. We may have something different. But I think that there have been redemptions from the emerging market bonds and equities. We have seen the impact in Indian markets, both the bond and equity. We have seen the impact on rupee. But I think a large part of it is behind us. I think it's already in the price, and maybe some amount of value buying is likely to emerge in our markets, which should support the currency as well.
Domestically though, Navneet, does it seem the need of the hour from the government and the central bank's end is only the currency volatility and sort of tapering that? Because once that happens, perhaps the market participants as well can, sort of breathe a sigh of relief.
Yeah, of course, the focus shifted from supporting the growth or probably tackling the inflation or boosting the investment suddenly to getting the stability in the currency market. Of course, most of the measures that the government and the RBI announced in terms of tightening on liquidity or some of the other measures were read like were interpreted by the market in a sense that the India is likely to impose some kind of capital controls, or so the measures were not taken positively by the market. But it seems that if I read the RBI statement of last week, it seems that I think there is some kind of change in stance, and maybe they are going to be supportive of growth once the stability returns. And I have a sense that I think we have seen the peak of volatility in the currency market. The current account is likely to significantly improve going forward. I think the flows are likely to resume at the current levels of bond yields and then the equity market valuation. And when that happens, once the stability in the currency market comes back, we might see RBI releasing liquidity and government kind of following up with more measures. There have been some positive developments like what they have done in the power sector and some of the other measures which I expect particularly to revive the mining, to revive the coal sector and all. But probably the market has not been very supportive. I think in the next few days the sentiments might change.
Navneet, just because valuations are at a trough, that does not mean that they cannot hang in there. Do you see a situation that markets may stop falling, but it will be a while before we will come out of this hole?
Yeah, of course it will take a time. The whole economic challenges that we are witnessing are definitely something which has been unprecedented. We have never seen such kind of lower growth along with a very sticky consumer price inflation. There are challenges on the fiscal side. If the growth slow down, then the tax revenues may not be as per expectations, and it can put further pressure because to maintain the fiscal deficit, government may have to cut maybe the planned expenditure. So some of these things are not very encouraging. We are increasing interest rates at a time when the country needs lower interest rates to boost investment. So these are not the best of the times. But as you rightly said that, I mean, well, ultimately what really matters is valuation, whether all this is already in the price, and second, the incremental change, whether that is going to be positive or the worst. My sense is that most of the economic data from here on will start showing positive direction, and starting with current account deficit, because that has been the single biggest challenge for the whole macro financial stability as the RBI and all the other economists and everybody believes. I think once that starts showing improvement, which I'm quite confident about, I think lots of other variables will start falling in place and the confidence may return back. And also from, as you mentioned, the global investors, because there have been redemptions in emerging market funds week after week for last several weeks, and India is getting impacted. They have been overweight on India, so obviously we also get some amount of selling. But that the whole tapering, as I mentioned, the concerns about tapering of quantitative easing are likely to taper off, and then maybe the sentiments might change in some time. And from the domestic investors' perspective, they've been so underweight equities that I think there is very little amount of selling that we can expect from that side.
So what's the right investor approach then, Navneet? In the near term, would it make sense to lap up IT as well as metal names? Do you think there's money to be made there even now?
That's more a trading view, but I think a broader call would be, of course, I mean, one broader theme one should look at is maybe the whole exports. I mean, exports not necessarily goods, but anything which can be exported out of India, because the currency has depreciated a lot. If you look at in terms of real effective exchange rate, I mean, currency is undervalued a lot now compared to some of the other trade partners like China. I mean, the rupee and in the renminbi, it's almost doubled in last 5 years. So I think we'll gain competitiveness. Domestic rentals are falling. I mean, the wages in real terms are falling. Once the interest rates come off and the commodity prices are lower, overall we may regain the competitiveness. So from a broader theme, rather than going into individual companies or sectors, I think something that can be exported out of this country can be quite an interesting thing. Of course, you need to look at the valuation, whether how much of that is priced in, but there could be several winners from that space.
Navneet, in the past, you've run a very consumer-stroke defensive-oriented portfolio. Some of your top holdings, they include names like ITC. You've got a large exposure to private banks. Are you looking at changing that portfolio, or you think in the near term, the onus is still on capital protection, not on capital appreciation?
The stance has changed over the last several months, as we discussed last time, that we are not as defensive, I mean, as probably we were in terms of the sectoral exposure and the individual stock exposure. Today, one of our biggest underweight would be consumer staples, because we are getting concerned about the valuations. Though we like the longer term consumption is going to be a long-term structural story for India. Having said that, we like some of the special niche companies rather than buying the large cap staples, and then we have cut down on that. Of course, metals we could not play the recent rally, but the portfolio stance has gradually been changing into buying some of the names where the valuations turned attractive, and then the markets have not been, I would say, have not been very favorable to them. But I think if you take a slightly medium to long term view, then some of those sectors were showing promise, and then we have built on that.
What about banks then, Navneet? Is there anything that you like from the PSU or the private banking lot, or do you think because of the systemic pain, it's better to just stay away from the space for another 1 to 2 quarters?
Yeah, we would have been underweight. I think it's going to see some pain even in the near term, because the cost of borrowing has significantly moved up, particularly those banks who don't have the retail franchise. I mean, the cost of wholesale borrowing has gone up. The overall asset quality concerns remain. But I would say that in some cases it's already in the price, and we have been overweight private sector banks, as you said. We continue with that, but selectively within the PSU, at least some of the larger names are the ones which are showing some promise at these levels.
Navneet,